Okay, and we're ready to go. So we are on deck 12 and handout number 21. So this is going to be relatively short today, as you can imagine, based on just the smaller number of slides. And so we will have some time at the end to deal with any questions or to just leave early. So whichever people prefer, I think generally. If we flip to page 2 of deck 12, we're going to talk about amalgamations as our first topic today. And the Act contains a ton of rules that apply to amalgamations. Most of these rules are set out in Section 87, and they apply to any transaction that satisfies the requirements in subsection 87(1). The effect of Section 87 applying is that an amalgamation will be a tax-deferred transaction, and that the historic tax attributes of the amalgamating corporations will be preserved. There's one possible exception here, which is where you might have a loss restriction event occurring on an amalgamation, which would happen if there's an acquisition of control on the amalgamation, which I don't think we're going to talk about that very much today, but that's something to keep in mind. But if generally speaking, the corporations are controlled by related persons and amalgamate, or were otherwise related to one another and amalgamate, then very clearly there will be a preservation of all the tax attributes of the amalgamating corporations. So what you see on the slide, these are the conditions for a tax-deferred amalgamation in subsection 87(1). First of all the property of the predecessors has to become property of the successor corporation. All of the liabilities of the predecessor corporations have to become liabilities of the successor corporations, and all of the shareholders of the predecessor corporations have to become shareholders of the successor corporation. And all of these things have to occur on the amalgamation and not as a result of an asset purchase or as a result of a winding up. So these conditions have all been simplified slightly versus what you'll see in the Act, because in the Act there's parenthetical language, etc., that basically carves out shares or debts of corporations, predecessor corporations that are owned by other predecessor corporations. Those necessarily all get canceled on the amalgamation. So for those of you who've taken corporate law, what you're going to get the sense of from reading these conditions of application is that basically anything that satisfies the requirements to be an amalgamation under the BCA, any Canadian BCA, is going to be an amalgamation for income tax purposes. The Supreme Court, in their decisions on this point, most notably the more recent decision in Envision Credit Union, has pretty much confirmed that it would be more or less impossible to have something that would be an amalgamation for BCA purposes that somehow breaks the requirements of subsection 87(1). So for all intents and purposes, like for any realistic practical purpose, if you can do it under the BCA, it's an amalgamation for income tax purposes that will occur with the consequences described in subsection 87(2). So flipping to slide 3, we can talk about the effects of an amalgamation. On an amalgamation, there are approximately 50 different prescribed tax consequences, most of which are contained in subsection 87(2). If you take a look at subsection 87(2), you'll see that it ends up with some ridiculous numbering where there's like paragraphs ZZ.2 and stuff like that. So it's just it's extreme, but there's a lot packed into that subsection, but about 50 different things that you could concern yourself with. Really, the important one comes early, and that's in paragraph 87(2)(a). And it deems the successor corporation to be a new corporation for income tax purposes. And this is an important deeming rule because under corporate law, the successor corporation is just a straight continuance of the two predecessor corporations, to use the Supreme Court's language from the 1970s. It's like two streams coming together to form a river, or whatever the exact wording was. But that's the analogy the courts would use. And so you do need a deeming rule to cause the amalgamated corporation to be a new corporation, as opposed to getting into a situation where you have to guess, which one of the predecessors or both would still exist and still have to file returns. So this new corporation has a new taxation year commencing on the date of the amalgamation. And because it's a new corporation, it's free to pick a taxation year end that may not be the same as the predecessors. It can pick anything as long as it's, complies with Section 249 and Section 249.1, which generally means that it just has to be not more than 365 days from the date of the amalgamation. The last taxation year of the predecessor corporations is also deemed to have ended immediately before the amalgamation. The CRA's position is generally that amalgamations occur at the first moment of the day on the date on which the certificate of amalgamation is issued. You may get a different result in some provinces where the provincial corporate registry allows you to timestamp a certificate of amalgamation happen at a particular time. But generally, if it just says the date, which I think is broadly the case in Alberta, then the CRA's admin position is that the amalgamation happens at the beginning of the day, so 12 o'clock a.m. on the date shown on the certificate. And what this means then is that the taxation year ends of the predecessor corporations end at 11:59 p.m. on the day before the amalgamation. So for this reason, what you will see is that amalgamations will almost always happen on the first day of a month, unless there's a commercial reason why they have to happen on a different date. But generally speaking, if you're doing something where you have control over the timing, you're going to do the amalgamation on the first day of the month so that the accounting gets much easier because you have a month end. And in fact, in practice, what most people like to do is do an amalgamation on the first day of a taxation year so that the predecessor's year ends on the amalgamation correspond with their regular taxation year end for income tax purposes, just to avoid a duplicity of filings. So notwithstanding paragraph 87.2a and this concept that the amalgamated corporation is a new corporation, the remainder of subsection 87.2 is essentially devoted to causing the tax attributes of the predecessor corporations to flow through into the new corporation. So provided that, again, your amalgamation does not result in a loss restriction event, then all of the fund pools like UCC, CDA, not eligible refundable dividend tax on hand, eligible refundable dividend tax on hand, non-capital losses, capital losses, etc., all flow through to the successor corporation. And the ACB of the property of the predecessor corporations becomes the ACB of the property of the successor corporation, obviously excluding any ACB in shares or debts that were canceled upon the amalgamation because they were shares or debts of predecessor entities. So again, the fact that you need to not have a loss restriction event is fairly important there. And again, in real life, that's something you would have to consider. You'd have to take a look at subsection 256.7 to see if there is an acquisition of control on your amalgamation, and if so, what the consequences are under section 251.2 and the various loss restriction event provisions. But generally speaking, again, tax attributes will carry through into the successor corporation. So if we flip to slide 4, we have some further consequences of an amalgamation. And the first is subsection 87.3. And like every other tax deferred reorg provision we've looked at in this course, there is a puck grind rule for amalgamations, and that's in subsection 87.3. And like most other puck grind provisions, it operates on a class-by-class basis. So the way this works is to determine the puck of the shares of the predecessor corporations, back out the puck of any intercorporate shares, so any shares of a predecessor owned by another predecessor, and then compare those to the puck of the shares of the amalgamated corporation. If the puck of the amalgamated corporation is greater than that amount, then you have a grind that gets you down to the total puck of the predecessor corporations less the intercorporate puck. And if you do have a puck grind, then just like subsection 85.1.2.1, it gets allocated on a class-by-class basis based on the relative puck of all of the shares of the amalgamated corporation. Then if we flip to slide 5, we have our last set of effects of an amalgamation. And this is subsection 87.4 and the rollover for shareholders. And so a rollover for shareholders is arguably necessary because of the deeming rule that deems the new corporation to be that deems the amalgamated corporation to be a new corporation. If it wasn't for that deeming rule, I think you'd very clearly say you wouldn't need a rollover because the successor corporation is just a continuation of the predecessor corporation. So there could never have been a disposition of any shares, and therefore there would be no need for a rollover. But because we have this new corporation, there is, at least for greater certainty, a rollover rule in subsection 87.4. What you will see from looking at subsection 87.4 is that it's comparatively lax relative to some other rollover provisions. All that is required is that shares of the predecessor corporation that are capital property be disposed of on the amalgamation, and the shareholder does not receive anything on the amalgamation other than a share of the successor corporation. So if those two very minimal conditions are met, then the shareholder is deemed to have disposed of the old shares for proceeds of disposition equal to the ACB of the old shares, and to have acquired the new shares at a cost equal to the ACB of the old shares. So relatively straightforward. Again, it functions basically just like any share-for-share exchange would. And like other rollover provisions, if there's more than one class of shares received, you do have to allocate the ACB of the old shares between the new shares. And the way this is done is just based on relative fair market value. So if you had, old shares of whatever class with a combined ACB of $100, and you have two classes of shares, both of which have a fair market value of $250, then you would just have $50 of ACB in each class of shares. So very simple proration based on fair market value. Then, if we flip to slide 6, we now can turn to the handouts and do problem 1, which isn't really that much of a problem, right? So if we look at it on the amalgamation of ACO and BCO, two taxable Canadian corporations, 100 shares of both corporations are converted into 150 shares in total of the same class of ABCO. The ACO shares have a fair market value of $500 and the puck of $100. And the BCO shares have a fair market value of $1,000 and the puck of $200. So it's asking what the effect is of subsection 87.3. And so, there's a few things you would need to assume here. The most important thing you need to keep in mind is that the corporations have to be taxable Canadian corporations in order for subsection 87.1 to apply, but the problem stipulates that they are, so that's good. The next thing that you would need to know is whether there's any intercorporate shareholdings between ACO and BCO, because that is going to impact the application of subsection 87.3. The problem doesn't mention that, so you can assume that there are no intercorporate shareholdings, and that these are two either sister corporations or completely unrelated corporations, et cetera, that are just amalgamating into one another. And so then with that assumption, the application of subsection 87.3 to ABCO is really straightforward, because all you would do is you would take the puck of the ACO shares of $100, the BCO shares of $200, you would add that together and say, okay, the maximum permissible puck of the shares of ABCO is $300. If the puck of the single class of ABCO shares exceeds $300, then subsection 87.3 will apply to grind the puck to $300. So that's that problem, and like I said, not really much of a problem. And that's all we have to do with amalgamations. So does anybody have any questions about amalgamations?
Yeah, I just have one question. What was the section that deems a corporation to be a new corporation?
That's paragraph 87.2a.
Okay, thank you.
No problem. Anyone else? Okay, seeing nobody, we can flip to slide 7. And we're now going to shift a little bit to windings up, which are really just, in many instances, substitutions for vertical amalgamations. So this isn't really that much of a shift. It's just something very similar. So windings up get somewhat more complicated than amalgamations, and they do have more potential to result in tax than an amalgamation would. And the reason for this is that the corporation that's being wound up is going to have deferred shareholder level tax on its undistributed retained earnings. And there's going to be unrealized shareholder level tax on any gains or loss that's accrued on the shares of the corporation that's being wound up. And as well, the corporation itself is going to have unrealized capital gains and losses at the corporate level on its assets that are being distributed to the shareholders on the winding up. And so we need rules that will apply in instances where where it's not a winding up of a subsidiary into a parent that owns all of the shares of the subsidiary, in which case it would just be, again, that would be economically the same as an amalgamation. And like we'll see on the next slide or the slide after, there are rules that basically cause the results to be the same as on an amalgamation in that case. But otherwise, for example, if we're winding up a corporation and the corporation's shareholders are a group of individuals, well, all of these concerns are very real, right? If we just allowed that winding up to happen on a purely tax deferred basis, like we would with a partnership, then there would either just never have been a level of corporate tax, or there would never have been a level of shareholder tax on either the assets of the corporation or the retained earnings of the corporation that are being distributed on the winding up. So we do need rules to deal with that and to cause that liquidation of the corporation to happen on generally a taxable basis. So and unlike amalgamations, there isn't a single place that you can look for all of the rules that will apply to a winding up. They're actually much more scattered throughout the Act. But there's a couple that we can focus on right now for the purpose of what would be a taxable winding up. The first is subsection 69(5). And what this does is it deems a corporation to have disposed of any property distributed on a winding up for proceeds of disposition equal to fair market value. And so the result of subsection 69(5) applying is that the corporation is going to realize any accrued gain or loss on the property that's being distributed on the taxable winding up. Then the other provision that we care about is subsection 84(2), which we spoke about extensively a few weeks ago in this course. And subsection 84(2) will deem any shareholder who receives property of the corporation on the winding up of the corporation to have received a dividend equal to the amount, if any, by which the fair market value of the property that they have received exceeds the reduction of the puck of their shares on the winding up of the corporation. So since the winding up of a corporation generally involves the cancellation of the outstanding shares of the corporation on the winding up, that's just what liquidations provide for under the BCA, etc., and how they're done in practice, then the practical result of subsection 84(2) applying is that the difference between the fair market value of the distributed property and the puck of the shares owned by the shareholders of the class is going to be the deemed dividend amount, and then that's just going to be allocated pro rata between the shareholders of that class. So that's the basic building blocks of a taxable winding up. And then if we flip to slide 8, we can see the next provision that is relevant, which is subsection 88(2). And subsection 88(2) gets bandied about in practice as being shorthand for a taxable winding up, but it really isn't, right? It doesn't actually prescribe any tax consequences except relating to the CDA of the corporation being wound up. So it's there because and it gets referred to because it's a provision that only ever applies to a taxable winding up, but it's not the provision. It's not like Section 87 where everything is self-contained within subsection 88.2. Subsection 88.2, in terms of what it actually does, is two things. First, for the purpose of computing the corporation's CDA, the subsection 88.2 deems the corporation's taxation year that to have ended immediately before the particular time that the distribution was made, and it deems the disposition of the corporation's assets under subsection 69.5 to have occurred immediately before the time that is immediately before the particular time. So in other words, to have occurred immediately before the deemed year end that precedes the distribution of the property on the winding up. And so the result is that the non-taxable portion of any capital gain that's realized by the corporation on the winding up is going to be added to the corporation's CDA immediately before the winding up. So that CDA balance will be there for potential use on the winding up. The next thing that subsection 88.2 does is it permits a part of the subsection 84.2 deemed dividend to be designated as a capital dividend. So you'll recall from a few weeks back that in order to have a valid designation as a capital dividend, you have to designate the whole dividend as a capital dividend. And so what subsection 88.2 does is when you have a subsection 84.2 deemed dividend on a winding up, it deems that dividend to be two separate dividends, with one part of the separate dividend being equal to the CDA of the corporation immediately prior to the winding up. So basically immediately after the year end that was deemed to occur immediately before the time that was immediately before the particular time. And so the result is that the corporation can now make a valid designation in respect of that part of the dividend that was otherwise deemed to arise under subsection 84.2. So the result is that the corporation's CDA will get used on the winding up as a result of subsection 88.2 applying. If you can't make use of subsection 88.2 because there's not enough CDA to cover the entire dividend, which would typically be the case, the remaining amount is just a regular taxable dividend, just like any other subsection 84.2 deemed dividend. So that's subsection 88.2. And then if we flip to the next slide, to slide 9, we now have a slide about intercorporate windings up. And like I mentioned, these are more similar to amalgamations and they get taxed in a more similar way. And this is subsection 88.1 that we care about here. And it applies, like I said, to intercorporate windings up. This provision applies if 90% or more of the shares of the subsidiary are owned by the parent, both the parent and the subsidiary are taxable Canadian corporations, and the 10% or less of the shares of the subsidiary that are not owned by the parent are owned by a person who deals at arm's length with the parent. If these conditions all apply, then the result is a tax-deferred winding up, which, like I said, is substantially the same result as you would get on an amalgamation. The subsidiary is deemed under paragraph 88.1a to have disposed of all of its property for proceeds of disposition equal to its cost amount, with the result being that no gain or loss should be realized by the subsidiary. The parent is deemed to have acquired the property at a cost equal to the subsidiary's proceeds of disposition under paragraph 88.1c. The parent is deemed to have disposed of its shares of the subsidiary under paragraph 88.1b for proceeds of disposition equal to the greater of two amounts. And this is this is a bit of a confusing thing because it's a greater of two amounts. The first of which is the lesser of the puck of the shares of the the lesser of the puck of the shares of the subsidiary, or the cost of the subsidiary's property distributed on the winding up plus the amount of money distributed on the winding up, or the ACB of the shares of the subsidiary disposed of on the winding up. So that becomes a bit of a mouthful because, we have this amount that's the greater of and then immediately drops you into a lesser of sub-formula. But the moral of the story is in these situations that provided the puck and ACB of the shares are equal, then the result is going to be that the disposition will not result in any gain or loss. Similarly, if the cost amount of the property distributed on the winding up exceeds the puck of the shares, you probably, again, cannot have any gain or loss on the winding up as long as the puck is equal to or less than the ACB of the shares. The only time you would have a problem under paragraph 88(1)(b) is if the puck of the shares is greater than the ACB of the shares and the fair market value of the property distributed, or sorry, not the fair market value, the cost amount of the property distributed on the winding up is less than the puck of the shares. So in that very unusual situation, you could have a capital gain on the winding up, even though it's an intercorporate winding up. That is really rare that you could ever have that happen, where there would be a material difference between the puck and the cost amount of the assets, and that both of those amounts are greater than, or at least the puck amount is greater than the ACB of the shares. So a very unusual. The standard practice is to avoid that risk entirely by just reducing the puck of the shares immediately before the winding up, by moving the puck to contributed surplus, which as a result means that there is no puck. So the lesser of the puck and the cost of the property is zero, and the puck will exceed the ACB because there's no corresponding ACB reduction when you move the puck to contributed surplus. CRA has given some unhelpful commentary over the last couple of years that they might consider GARing that, which is frankly kind of dumb. And what they've managed to confine their comments to is in circumstances where it looks like you might duplicate a loss as a result of having the tax deferred winding up in situations where puck exceeds ACB, and reducing the puck in order to make sure that you duplicate the loss. The examples they gave where that could happen were really contrived. So I sort of think they came across one file at CRA rulings, but they had a result that they didn't like, because somebody reduced the puck and decided to put out that position, which I don't think is going to be broadly applicable. And although you have to make note of it, if you're doing a winding up where you're going to reduce the puck prior to the winding up, I think the circumstances in which the GAR could actually apply to that, or which the CRA would even try to assess the GAR, are so narrow that it's probably almost never going to be relevant to your interests. So that's the tax consequences of the winding up generally. With respect to the tax attributes of the subsidiary, paragraph 88(1)(e)(2) causes the rules in subsection 87(2) to apply to the winding up as though there had been an amalgamation with some modifications. So the result is generally that, again, the parent corporation is going to get the subsidiary CDA, eligible refundable dividend tax on hand, non-eligible refundable dividend tax on hand, capital gains, sorry, not capital gains, capital losses carried forward, non-capital losses carried forward, et cetera, et cetera. So again, all the fun stuff ends up in the parent. There is one timing issue that you do have to be careful of, and that's just the time at which the losses become available to the parent. Unlike an amalgamation where it's really easy, right? The losses of the subsidiary are available to the successor corporation immediately in the taxation year commencing on the amalgamation. It's not quite so simple with a winding up. What actually happens is that the the parent corporation gets to deduct the losses in the first taxation year commencing after the winding up, but only if the subsidiary is wound up by the end of that taxation year. And generally, the CRA interprets wound up as meaning is that articles of dissolution have been filed under the BCA. So you have this, it's a bit of a timing difference where if you want the losses right away, because you have a transaction that you want to do in the future, an amalgamation might be better depending on what the parent's year end is relative to that transaction. Similarly, but not entirely similarly, if the transaction has already happened in the parent's taxation or before you've wound up the subsidiary, you might be a little bit screwed. I mean, you'd be screwed in amalgamation too, but you have a problem here where you're not going to get the losses in time, and generally speaking, don't get a carryback for the losses. So it is a timing problem. So if you have a subsidiary with losses and you want to consolidate them into the parent on a winding up or an amalgamation, you do have to be sensitive about when you're doing it relative to when the parent expects to earn income in order to make sure that your losses end up in the right place at the right time. Another point of interest just to take a look at in paragraph 80, in subsection 88.1 is paragraph 88.1d.1. And paragraph 88.1d.1 provides that subsection 84.2 is inapplicable to an intracorporate winding up that qualifies under subsection 88.1. So basically the idea here is supposed to be that subsection 88.1, including the provisions of subsection 87.2 that got dragged in by incorporation under paragraph 88.1e.2, are functionally a complete code, right? That everything that's going to happen on an intercorporate winding up should happen somewhere within subsection 88.1. And the other important deviation that we see from from what you might otherwise expect is the bump that's provided for in paragraphs 88.1c and d. Essentially, the way that the bump works is that where the parent has at some point acquired control of the subsidiary from an unrelated person, so that you have a difference between the outside ACB of the shares and the lower inside ACB of non-depreciable capital property, then on the winding up of the parent corporation, of the subsidiary corporation into the parent can bump the non-depreciable capital property of the subsidiary corporation that's distributed on the winding up to cause the ACB of that property to increase potentially to a maximum of the ACB of the shares of the subsidiary that were canceled on the winding up. So this rule is not actually unique to windings up, because subsection 87.11 drags in this rule for the purpose of a short form vertical amalgamation. So in some cases you can bump on an amalgamation, and in many ways it's actually easier to do the bump on the amalgamation just as a corporate law matter. But so it's there. And if you recall all the way back to week 1, we did talk about how it was in some instances possible to bump the property of a partnership on the winding up of a partnership where you had outside basis in your partnership interest that was higher than the inside basis of the property of the corporation, again, of the partnership rather, and again, limited to non-depreciable capital property. So this is something that you've at least conceptually seen before. What we can say about the bump rules is that they're tremendously complicated, and they are, in fact, some of the most complicated domestic corporate tax rules in the entire Income Tax Act. So we're not going to talk about them today. It would take more than the next 2 hours to go through the bump rules and the bump denial rules and how they interact, with the butterfly rules in paragraph 55.3b, which they do. It would be a lot, right? And so we're not going to deal with it. Just know that they're there. And if you do end up practicing tax, you are going to spend a bunch of time looking at the bump rules and the bump denial rules. And in fact, if you work in a large firm, there's probably going to be somebody who has a very substantial part of their practice just being the expert in dealing with the bump rules / bump denial rules. So, with good fortune, maybe that person could be you. But yeah, to illustrate how complex they are, like I have had colleagues who've left Faleski to go to other firms, and are extremely smart people who think very deeply about tax, and they'll still phone to gut check on bump issues because it's so complicated, and you can talk, if you think about the bump long enough, you will almost always find a reason why it should be denied on some ridiculous technicality, and then you just have to find a way to get yourself to give an opinion anyway about the bump. So it's complicated. It's a lot of fun. It's very complicated though. The last thing we want to talk about with subsection 88.1 before we move on is this. The important point is that it only applies to the parent on this winding up, right? If you have the very unique situation where the parent is not the sole shareholder on the winding up, and there is this 10% or less shareholder who deals at arm's length with the parent, subsection 88.1 does not apply to that minority shareholder. That minority shareholder gets the same treatment they otherwise would under subsection 84.2. So they would potentially have a deemed dividend to the extent that the property distributed exceeds the puck of their shares. Subsection 69.5 is going to apply to the property that's being distributed to that person. So the corporation also doesn't escape tax entirely on the winding up where you have the minority shareholder. What this means in practice is that just because of the complexity that this adds, is that everybody is generally better off if the parent corporation buys out the minority shareholder before you do the winding up. In very rare circumstances, it might make sense to have that minority shareholder there. For example, if you were planning to use them as a mule to recover refundable tax or something, there might be some value there. Or if you wanted to realize a loss on the shares of the corporation, so you wanted to try to break subsection 88.1 for whatever reason. But generally speaking, much easier if the parent buys out all the other shareholders and then does the winding up so that the entire thing is self-contained within subsection 88.1. And so with that, we can, before we turn to, I guess we can turn to our problem 2. Before we turn to problem 2, does anybody have any questions about windings up? Okay, seeing nobody, let's go to problem 2. So problem 2, we have XCO, which has a calendar year fiscal period, and XCO owns non-depreciable capital property, which are limited to shares of PubCo, with an ACV of $5,000, a fair market value of $10,000, so a accrued $5,000 capital gain, and it has $5,000 of cash on hand, so $15,000 of property in total. The sole shareholder of XCO is X, an individual who owns shares with a PUC and ACV of $5,000. On March 1, 2021, proceedings are commenced to wind up XCO. On March 30th, all corporate property is distributed to individual X, and articles of dissolution are filed on the same day. What are the tax consequences to X and XCO on the winding up? So, what I think we're going to do here is let's ignore the corporate tax consequences to XCO because we can focus on the mechanics easier if we're not worried about that so much. We're going to see in the next iteration the problem we are being forced to care about corporate tax, so we'll deal with that in the next iteration. But for now, let's focus on the mechanics. So what happens here? Well, X is an individual, and so we know that this cannot be a subsection 88.1 winding up because it's not the case that the parent and the subsidiary are both taxable Canadian corporations. So we have just a regular taxable winding up in this case. So on the winding up, subsection 69.5 is going to deem Exco to have disposed of its property immediately before it's distributed. And so that should result in Exco realizing its accrued capital gain. That's very annoying. Okay, Exco will realize its accrued capital gain. And so this that's part of it. And then obviously individual X is going to be deemed to have acquired the Pubco shares for their fair market value of $10,000. If we assume that X is resident in Canada, or sorry, Exco is resident in Canada, which we probably should, then in that case, individual X is going to be deemed under subsection 84.2 to have realized a deemed dividend of $10,000, which is the difference between the $15,000 of property distributed and the $5,000 of PUC in X's shares of Exco that would have been canceled on this winding up. Then what we're going to have is subsection 88.2 is going to apply to this $10,000 deemed dividend under subsection 84.2. And this $5,000 capital gain that Exco realized is going to be deemed to have been realized immediately before the time of the winding up and with the intervening deemed year end. So Exco should have a $2,500 CDA balance at the time that the winding up deemed dividend arises. And so that $2,500 deemed dividend should be deemed to be a separate dividend. And we can assume that Exco is going to designate that $2,500 separate dividend as a capital dividend, which would be received tax-free by X. And so the result is that X should have a $2,500 capital dividend and a $7,500 taxable dividend to contend with here. Then we can turn to the disposition of X's shares of Exco. And we know that X's shares, that X received property totaling $15,000, but $10,000 of that was received as a dividend, either as a taxable dividend or a capital dividend. So paragraph J of the definition of proceeds of disposition in section 54 should apply and should reduce the proceeds of disposition by the amount of that deemed dividend. The result should be that X would have proceeds of disposition of $5,000 and would have ACB in his or her shares of Exco of $5,000, and so should realize no gain or loss. So at the end of the day, Exco should have shares of Pubco with a $10,000 ACB and $10,000 fair market value, should have $5,000 of cash, and should have received a $2,500 capital dividend and a $7,500 taxable dividend, and would have tax payable on that taxable dividend somewhere between 34.3% and 42.31%. So that's the base case scenario. Is everybody okay with that?
Could you please go over the capital dividend account really quick under 88.2 and 84.2?
Yeah, for sure. So what happened here was that on this deemed disposition under subsection 69.5 of the Pubco shares, Exco realized the capital gain of $5,000, which was the difference between the $10,000 fair market value of the Pubco shares and their ACB of $5,000. So 84.2 deemed there to have been a dividend on the distribution of the Pubco shares. Subsection 88.2 applies to that deemed dividend, and it does two things. First of all, it deems the taxation year of Exco to have ended immediately before the time that was immediately before the particular, deems it to have ended immediately before the time that the deemed disposition occurs. and it deems the disposition under subsection 69.5 to have occurred immediately before the time that's immediately before the particular time, with the result being that that $2,500 non-taxable capital gain has been added to Exco's CDA at the time that the deemed dividend under subsection 84.2 arises. Then subsection 88.2 deems the $10,000 dividend to be two separate dividends, one for $2,500, which was the amount of the CDA at the time of the winding up, and it deems the other $7,500 to just not be to be another chunk of dividend. So then, because there's $2,500 of CDA and a $2,500 dividend, Exco can elect and would, right, in any circumstance, would elect for that $2,500 dividend to be a capital dividend. And so that results in X receiving that $2,500 tax-free. And then the $7,500 dividend is just a taxable dividend. If there was GRIP, it could be designated as an eligible dividend. If there isn't, then it's just a regular taxable dividend.
Thanks so much.
No problem. Anybody else? Okay. Seeing nobody else, we can move on to the second iteration. And so in the second iteration, the problem asks, what if Exco receives a dividend on the Pubco shares of $1,000 on February 28, 2021? So we have a March 30 winding up, and Exco received a dividend before it was wound up. So what this is trying to make us do is it's trying to make us think about RDTOH, and specifically in this case, since Pubco is a Pubco eligible RDTOH. So this dividend that's received by Exco, I think we can safely assume is going to be subject to Part 4 tax, since essentially nobody is connected to a public corporation. If you're connected with a public corporation, you know that you are because you're extremely wealthy, and that's fun. But generally speaking, nobody's connected to a public corporation. So we can assume there's going to be Part 4 tax on this dividend, and we can again assume because it's a public corporation, it can designate any dividend as a eligible dividend as long as it has no LRIP. So we can assume this was an eligible dividend, and that this eligible dividend is going to be added to the eligible RDTOH of Exco, and that Exco is going to have paid Part 4 tax equal to 38 1/3% of the dividend received. So it should have 3,833-ish. Sorry, thereabouts. It's $1,000 of dividend. Oh my God, $1,000 of dividend, not 10,000. So it would have $383.33 of eligible RDTOH created as a result of receiving this dividend. This gets added to eligible RDTOH, this Part 4 tax paid on the eligible dividend under the definition of eligible RDTOH in subsection 129.4. What we're also going to see here now is that because we're focusing on the corporate tax, we're also going to focus on this $2,500 taxable capital gain that arose on the deemed disposition of the Pubco shares on March 30th when the corporation was wound up. And so this is going to result in an addition equal to 30 2/3% of the taxable capital gain that was realized on that disposition, which should be $766.67, and that gets added to non-eligible RDTOH because that's just a regular taxable capital gain. So we have that. The dividend itself is, effectively and nothing. It was deductible under subsection 112.1, we assume. So we don't really care about that, the fact the dividend has been received, but it does increase the cash on hand in Exco. So now instead of having cash of $5,000 and $10,000 worth of shares. It has $10,000 worth of shares and $6,000 of cash. So what that's going to do is it's going to cause the deemed dividend to go up from, I think if we ignore the liability to pay the corporate tax, it would cause the deemed dividend to go up from $10,000 to $11,000. However, again, what's going to end up actually happening is that $400 of that cash would have to be retained by EXCO in order to pay the corporate tax. So really, it would cause the deemed dividend amount to go up from it would cause the deemed dividend amount to go up from $10,000 to $10,600, with $400 being retained to pay the non-refundable portion of the corporate tax on the taxable capital gain. So then we still have this deemed dividend of $10,600 under subsection 84.2 on the winding up of EXCO. And again, we still have $2,500 that's going to be deemed to be a separate dividend under subsection 88.2. And so our remaining $8,100 of dividend is going to be a taxable dividend, but because the corporation should have $1,000 of GRIP as a result of having received the $1,000 dividend from Pubco, it should be able to designate $1,000 of that dividend, the $8,100 deemed dividend, as an eligible dividend. And so there should be now, as a result, $2,500 of capital dividend, $1,000 of eligible dividend, and $7,100 of non-eligible dividend. And the corporation, as a result of paying these deemed dividends, does qualify for a dividend refund under subsection 129.1 of both the eligible RDTOH created on the receipt of the dividend from the public corporation and on the non-eligible RDTOH created on the taxable capital gain, because obviously our $7,100 dividend is way more than we needed in order to recover the $766.67 of non-eligible RDTOH, and the $1,000 eligible dividend is exactly 2.61 times the $383.33 of eligible RDTOH that was on hand. So that's the result. And so essentially it's pretty similar to what it was before, but now we sort of see the impact of the corporate tax, and we see the refunds of the in and outs of the RDTOH happening as part of this transaction. Everybody okay there? Okay, and then finally, we have the last iteration of the question, which is, what if X were a taxable Canadian corporation and not an individual? And so this is the simplest iteration, right? Usually these things get more complex as we go through the iterations. This is the simplest one, right? If X were an individual, if X were a corporation, so let's call this YCO, is the shareholder of XCO, and it's a taxable Canadian corporation, it's the sole shareholder of XCO, which is also a taxable Canadian corporation, then the result here is going to be that subsection 88.1 applies, right? So the result is going to be that the Pubco shares get disposed of for their cost amount, their ACB, under paragraph 88.1a. YCO is deemed to have acquired the Pubco shares at their cost amount under paragraph 88.1c. Paragraph 88.1b is going to deem XCO to have disposed of the shares for the greater of, number one, the lesser of the PUC of the shares of $5,000, or the fair market value of the property distributed plus the money distributed, which is $15,000, so $5,000. or 2, the ACV of the shares, which was $5,000. So no matter what, the proceeds of disposition of the shares are $5,000. The ACV was $5,000, so no gain or loss. So this just becomes a totally tax-deferred transaction, and WICO ends up with all the property at its historic cost amount. Everybody walks away happy as a result. So that's that result, and that's the that's all we have with problem 2, and that's all we have in unit 12. So does anybody have any questions about unit 12?
I just kind of have a general question. Would we be so there's obviously like 50 or like 100 sub provisions inside like the amalgamation and kind of the wind up provision as well. Like would we be expected to know all of those, or would we just be expected to know the general effects?
General effects. Let's put it this way, I do not know what all 50 of those consequences are because they're not relevant most of the time. So yeah, don't worry about the specifics. I mean, I'm sure there's stuff about like dealing with taxable capital that we just don't need to care about at all. Anybody else?
For the second iteration of this last question,
Yeah.
do you mind just going over again how to calculate the non-eligible refundable dividend tax on hand from the taxable capital gain?
Yeah, for sure. So it would just be the non-eligible RDTH would just be 30 2/3% of the taxable capital gain. So it would be, in this case, that's $2,500 of taxable capital gain multiplied by 30 2/3%, which should be $766.67.
Perfect, thanks.
Okay. Anyone else on Unit 12? Okay, seeing nobody, I'm going to stop recording.